Hello there, we're now going to have a look at chapter 2 and we're going to have a look at the financial statements of a business. Now ultimately, you may be asked to prepare a financial statement or part of it, and chances are it'll be little bits of a financial statement. Now remember, as we said in the last chapter, we are always going to be financial accountants in F3. You won't be asked to do management accounting because that's what you do in F2. So, we need to know what the financial statements look like, and these are really going to be the end product of what you're going to learn over the coming chapters. So this is the end goal, as it were. We can see what we need to prepare in the end, and then we can start from the beginning and work towards this end set of financial statements. Now there's 4 financial statements in this syllabus: the statement of comprehensive income, the statement of financial position, the statement of changes in equity, and the statement of cash flow. In this particular chapter, we're going to focus on the 2 main financial statements. The statement of comprehensive income, that will be in this recording, and then the statement of financial position, which will be in the next video. So, the 2 primary financial statements then we're going to have a look at. We'll deal with the other 2 financial statements in later chapters. Right, so, statement of comprehensive income then. The purpose of a statement of comprehensive income is to show all the income and expenses of an entity over a period of time. Now, what we need to think about here is that a business ultimately wants to make a profit, and the statement of comprehensive income is going to show whether that company or that business has made a profit or a loss in the year. So this statement of comprehensive income really shows the performance of a business over the year. So it's going to show whether they made a profit or loss in that year. And how do you make a profit? Well, you buy goods and you want to sell those goods for more than what you bought them for. Okay? So what we sell goods for would be income, and what we buy them for, the cost, would be expenses. And that's what the statement of comprehensive income does. It shows all the income less all the expenses of a business to give a profit or loss for the year from their trading activities. So I like to think of a statement of comprehensive income as a video recording, like what you're watching now. We're going to record every income and expense that's happened during the year, and then at the end of the year, we're going to stop the recording, take the tape out, and then summarize what has happened in that recording in the year, and that will be the statement of comprehensive income. So it's going to summarize all of the income and expenses of a business for the year, and then it's going to show a profit or loss at the bottom. So this is a financial statement that's really important, and this is really one of the most important things you can learn in F3. So let's take a look then at the statement of comprehensive income. Now notice I said it was a video recording for the year of all income and expenses. So the statement of comprehensive income is going to have a certain title. It's going to be for the year ended. So all our income and expenses for the year ended, in this case, the 31st of December 2009. Okay? So it's always for the year ended. Okay? Everything in the year up to the 31st of December 2009. And that would be our year-end cut-off. Now, with the statement of comprehensive income then, we have 2 columns. The column on your left would be a subtotal column, and the column on your right is a total column. And in this case, everything is expressed in thousands of dollars. So, at the top then, we start with revenue. And this is going to be your revenue from your sales. So if your business, let's say, is buying and selling, I don't know, calculators, or manufacturing calculators and selling on the finished product to your customers, the total value of all the calculators that you've sold in a year, in this case, which would be $233 million, Well, that would be your sales revenue for the year. Okay, so your sales revenue. Sales revenue is income to the business. It's money coming in. Okay, and remember we said a statement of comprehensive income shows all the income in, less all the expenses or costs out of the business. Now, if you're manufacturing calculators, there's going to be a cost to make what you sold. And our next heading would be cost of sales. And cost of sales is an expense. Okay. Cost, expense. Okay. So we less cost of sales. We're going to minus the cost to make what we sold. We have to work that out though. Okay, it's not just going to be a figure given to us in the exam. Cost of sales is made up of the following components. The first one is opening inventory. And this would be your stock at the start of the year or at the start of the accounting period. So if you have a stock of calculators that you manufactured last year, but you didn't sell them last year, well, at the start of this year, they would still be in your warehouse ready to be sold. And it's most likely that if you had them in stock at the start of the year and you've manufactured new goods in the year, you probably would have sold these before you manufactured new goods. So opening inventory, stock at the start of the year, chances are you would have sold it. The cost of that stock to make, well, that would be your opening inventory. Now what we're doing here is just introducing terms. Pretty much every line in this statement of comprehensive income we're going to analyse separately to make sure that we know the calculations in depth. So there's plenty of chapters after this chapter which deal with cost of sales, with inventory, with sales, etc. This is just to give you a brief overview of the layout, to give you a feel for what ultimately you'll be asked to prepare. Okay, so next thing we're going to have a look at then is purchases. Now, if you purchase plastic or components for this calculator that you use in your manufacturing process, well, your purchases would be a cost to you in the year. So the purchases of goods, so of materials, well, that would get added to your opening inventory. Now, if you're a business that buys in calculators from a wholesaler and then you're selling them on because you're the retailer, well, that's fine. Your opening inventory will always be the finished goods, and also your purchases will be the purchases of complete goods from the wholesaler. Okay? So if you're a retailer, let's say, then your purchases will be of complete units. Now, purchases, of course, will be an expense. It's a cost to the business. Our next line is carriage inwards. And this is the delivery cost on purchases. Okay? So carriage inwards is the delivery cost on the goods that you purchase. So if you incur delivery costs on bringing your calculators into the business, or maybe for delivering the components of the calculators into your business if you're a manufacturing entity, well, that delivery cost is a cost that you incur in order to bring in those calculators and then to sell them. It is a cost of selling goods. So therefore we add it to opening inventory and purchases. And we do a little subtotal at that point. Now, in reality, most businesses won't buy all their calculators and then sell them all at the end of the year. Chances are by the year end, they'll still have a stock of finished calculators in their warehouse. Now, if they're still in your warehouse, you haven't sold them. So it would be unfair to include them in the cost of sales because you haven't sold them yet. Therefore, it's not a cost of sale. So, any closing inventory, stock left at the end of the year, can you see that would need to be taken away? So let's say that you purchased 1,000 units of calculator, but you only sold 950 of them in the year. Well, 50 units valued at their cost, well, that would be taken out, okay, because you haven't sold them yet. It's not a cost of sale. That's why we call it cost of sales, okay. Now, we're going to see this principle later on in Chapter 4 when we deal with inventory. But for now, what we must remember is any goods not yet sold, we need to take them out of cost of sales because we haven't sold them yet. Essentially, we're going to defer that cost of that stock at the year end into next year as, guess what? Opening inventory. And opening inventory increases in expense, if you remember. So, we're going to take out closing inventory at the end of this year and move it into next year's statement of comprehensive income as opening inventory. So 1 year's closing inventory will be the next year's opening inventory. Okay, so we will see this figure again, but in the next accounting period, and we will match that against the sales that we made because we must have sold them next year. For now, though, any stock left unsold would need to be deducted from cost of sales because you haven't sold them yet. So, can you see then that opening inventory plus purchases plus carriage inwards less closing inventory is going to equal total cost of sales. And that would be your total expense, that 118,662. And that's going to come off the total sales revenue in the year. And that's going to give you gross profit. So sales minus cost of sales, the cost to make what you sold, will give you a gross profit. And that's known sometimes as your trading profit, your main profit from buying and selling goods from your main operating activity of your business. Okay? Now at that point, we can add any other forms of income. So, if we receive any discounts on purchasing goods from a supplier, or discounts received would get added at that point. Okay? So discounts received from credit suppliers, and when I mean credit suppliers, I mean we're promising to pay the supplier at a later date, but when we do pay them, we get a discount. Well, that would be discounts received. That's income. That's a good thing to the business. So we'll write that in. That is income. But we could also have some other forms of income that is not your main sales revenue. So maybe you have a property on your books, okay, and you're a manufacturing entity, but the property that you have, you don't use it in your business, you rent it out to some tenants instead as an investment property. Well, any rental income that you get from that would not be your main sales income, but that would be an example of other income. Okay, so you could have rental income, you could have commission that you receive from referrals. Okay, there's lots of different forms of other income which you'll come across throughout the course. But any income that's not your day-to-day trading income is essentially added to gross profit and then subtotaled once again. Now that subtotal doesn't really have a name, it's just a subtotal. Gross profit plus other income, if you like. Then what we must do is less all our other expenses. So all our other expenses that will be incurred, maybe not from cost of selling goods, but other costs that we could see happening in a business. So we could have discounts allowed. And this would be discounts that we have given to credit customers. Now, if we sell goods to a customer for $100, that $100 would be sales income or sales revenue. But when the customer pays you, they take $2 off. Okay? That $2 is a discount that you've given them, maybe for paying early. In which case, you've overstated your sales income of $100. It should actually be $98 because they took that $2 discount. Well, how we present that is say, okay, well, we sold goods for $100, but we've given a discount, we've allowed a discount of $2 at the bottom. So we show discounts allowed as an expense, and remember, expenses reduce income. Okay, because remember, we want to find a profit at the bottom. Again, we'll see discounts allowed once more in later sessions. Depreciation, well, that is the write down in value of assets, or long-term assets if you like. So if, let's say, you have a car that you use in your business, maybe it's a salesman's car, well, the value of the car today will not be the same value at the end of the year. And that's because you're using it. You're using that vehicle to make a sale. As such, if you think about a car, it does go down in value over time the more you use it, the more mileage you clock up. And that's going to be a cost to the business. We need to write down the value of that car and then charge it as an expense called depreciation. And essentially, you need that car for your salesman to go and make those sales, which you recognise at the top. It's not technically a cost of sale, because it could be for other equipment as well, machinery, maybe even your buildings. But we generally say depreciation is another expense, but it is a cost that the business incurs in order to use its assets. Okay. Again, we've got a whole chapter devoted to long-term assets and depreciation later on. But for now, just to understand that it's an expense will do. We could have other expenses, gas and electricity. Well, you need power to light your warehouse to make your calculators. That would be a cost to the business. Irrecoverable debts. Well, if, let's say again, that you have a customer and you sold goods to them for $100, you would recognise that in sales. But if your customer doesn't pay you at all, maybe they've gone bankrupt or they've disappeared, you need to strip out that $100 income as a bad debt. So sometimes known as bad debts, but in the exam it would be known as an irrecoverable debt. Again, it is an expense to the business. We've got to strip it out of sales income, but show it separately. Again, we have a whole chapter devoted to irrecoverable debts later on. We could have loan interest. So if we take out borrowings from the bank, obviously there's going to be a cost. We don't get that money for free. The cost would be the interest. The interest would be an expense or a cost to the business. Carriage outwards. That would be the delivery charge on sales. So if we suffer a delivery charge on selling goods to customers, that would be known as carriage outwards, and that would be an other expense or a selling expense. Okay? But it wouldn't form part of cost of sales. Cost of sales is carriage inward, the delivery cost on purchases. The delivery cost on sales, carriage outwards, would be just a general expense, a selling expense. We then have some other expenses, water rates, advertising and marketing, and other expenses would all come off. And notice the sum of that subtotal will be brought across to give your total expenditure. And notice anything we put in brackets as accountants, we put is a minus, as a deduction. It's very easy to confuse a minus here. It might be an extension to a number 1, for example. So we make it very clear that we minus everything in accountancy by putting it in brackets. Okay? So the sum of gross profit and other income less your total expenses will equal your business profit for the year. You might have seen this referred to in real life as net profit or your bottom line profit. Okay? And that's how we calculate net profit, and this pro forma is specifically for a sole trader. We're going to have a chapter later on limited companies, and it's largely the same thing, but the pro forma is slightly different. Okay, but it's the same idea. So the statement of comprehensive income, income less all your expenses, will give you a profit or loss at the bottom. You must learn this pro forma and you must be able to apply it as well. We're going to actually have a look at how we calculate the statement of comprehensive income in the next chapter, chapter 3. But for now, this is the end product. You need to know that it's a summary of the business's income and expenses for the year. Thank you.